Hey folks, welcome to this edition of Red Acre's Video Insights. We're talking today about Pain Therapeutics and Durect Corporation. Pain and Durect are both microcap companies with about $130 million in market cap, and they both have a binary event coming up because Pain's commercialization partner, Pfizer, has its Q1 earnings call on April 30th. So just a quick history here. Pain Therapeutics, their phase 3 asset is Ramoxi. It's licensed from Durect Corporation, and Pfizer is the commercialization partner that's heading up the development right now. Back in July of 2011, you see this big drop in the chart, and that was because they received a complete response letter from the FDA. The stock really hasn't recovered since then. It's hovering in the $3 range, and we see a run-up starting in August of 2012. This was because people were expecting, based on Pfizer statements, that by the end of the year there would be some decision on the go-forward plan for Ramoxi. Instead, what happened on November 1st is, during the Q3 conference call, Pfizer made some equivocal statements. They said, we're going to meet with FDA in March of 2013 once some bioavailability studies finish, and based on the results of that meeting, we're going to make a net go, no-go decision. That's not language that investors wanted to hear, and they punished Pain Therapeutics for it. The stock dropped more than 36%. And as you can see here, it's been in an ascending triangle, but the stock really hasn't recovered from that big drop on November 1st. So now, let's turn our attention over to Durect Corporation. And again, we see a drop here in July of 2011 because of that complete response letter, and the stock has been trading down ever since. We see that same run-up from August towards the end of the year in 2012. We see this drop, and it dropped all the way down to 61 cents. But Durect has actually recovered almost all of that loss. Just a few weeks back, we see the stock at $1.49, which basically is the level it was at on November 1st. We like to see this ascending triangle pattern because it means that investors are getting back into the stock. And they're getting into Durect not just for Ramoxi, but because Durect also, just this past week, announced that they've submitted the NDA for Positor. So they have another phase 3 asset that is under review by FDA, and potentially by February of next year, we'll have a decision on that. And here's the way that we're trading these two stocks. We know that basically, if Pfizer says they're going to scrap Ramoxi, then both of these stocks are going to take a hit. And we don't want to lose our money. We hate losing money here at Red Acre, and you should hate it too. So we want to find a way to hedge our trades. Okay, so here's the trade that we're going to do. We're going to go long Durect, and that's going to cost us $1.30, maybe $1.32, but let's just call it $1.30. So long Durect. Now, we know that if Pfizer scraps Ramoxi, we're expecting Durect to trade down to 2x cash, so around 50 to 54 cents. So we have the potential to lose 80 cents. How do we get 80 cents worth of protection? We're not going to find that protection in Durect, but where we are going to find it is in the options for Pain Therapeutics. Pain is trading in the $3 range. It just this week went sub $3, but it's still trading above $2.50. And the May $2.50 puts for Pain Therapeutics cost 25 cents in order to go long. So go long Durect and go long the May $2.50 puts for Pain Therapeutics. And why are we doing that? We expect that if Ramoxi is scrapped, Pain should trade pretty much down to cash, which is $1.24 a share. And since your puts are at $2.50, you're getting $1.25 of downside protection. You spent 25 cents to buy that put, so you're really getting a dollar of downside profit. Match that to your 80 to 90 cents of downside protection that you're looking for. That gives you a flat trade in the event that Ramoxi is scrapped. On the other hand, if Pfizer decides to keep Ramoxi, we see this level of $2.30, if not $3 or higher, as the level that Durect should be trading. It should basically fully recover from the recent hits that it's taken. And so you're giving up 25 cents of the upside, but you're getting a trade where you basically have no downside. The only way this trade breaks is if before the May options expiration comes about, if Pfizer doesn't give us a decision, if they on the Q1 conference call don't discuss Ramoxi, or if they say that we haven't had our meeting with FDA or we haven't had an answer from FDA yet, then your puts basically are 25 cents wasted. You can still keep your long Durect shares and rebuy some puts in Pain Therapeutics, maybe the October puts, which are costing about 50 cents, and you'll be able to put that hedge back on. So that's our trade, our hedge trade for Durect and Pain Therapeutics, long Durect and the Pain $2.50 May puts to protect on the downside. As with every trade, we encourage everybody to do their own due diligence. We remind you that we are not registered investment advisors, and this video is not specific investment advice for any individual that's listening to it. This is just how we see the trade, and you should use it for educational purposes. You can catch other Red Acre Insights at www.redacre.com. You can follow us on Twitter at Red Acre. We'll be having further details of our soon-to-be-launched premium service, so if you haven't signed up for our email list, make sure you do so. And thanks for watching.